Hello, everyone. Welcome to our panel discussion on tech and the future of financial services as part of the first ever UK Fintech Week digitally. Thank you to Innovate Finance for organising this series of webinars. It's a testament to the ingenuity of the fintech industry that at such short notice, Innovate Finance were able to pivot their global summit and the week's activities into a digital showcase. With technological innovation transforming the world around us, today's panelists will help us to understand how innovation and progress are changing the way things are done, both in the financial services industry and beyond, what we can learn from the perspective of consumers, and how today's current landscape and the speed of innovation may give us a glimpse of the future. So to help us navigate these issues, I'd like to introduce our speakers for today. First, John Hourican, CEO of New Day, a role which he took up in September 2019. Prior to this, John served as CEO of the Bank of Cyprus, the largest banking and financial services group in Cyprus between 2013 and 2019. John was named Euromoney's Banker of the Year in 2015. Next, Andy Ellis, Head of Ventures at NatWest. Andy leads NatWest's proactive response to the tech disruption. He is responsible for building and scaling a portfolio of standalone digital businesses to generate new revenue streams across NatWest. And we have Margaret Doyle, who is Chief Insights Officer for Financial Services for Deloitte UK. Margaret started her career at McKinsey before working as a financial journalist, covering business and finance for The Economist and The Daily Telegraph, edited the Global Agenda, and covered investment banking for Reuters Breaking Views. She's also guest presented several flagship current affairs BBC programs, including Today, The World Tonight, and Analysis. Thank you all for being part of this discussion on the future of tech and financial services. So before I kick things off with a few questions of my own, to those of you listening, there should be a box on your screen where you can submit questions. Please do send them in, and I'll ask as many as I can to our panel today. Fintech is an incredibly important and fast-moving industry, and one which supports increasingly diverse products, customers, and sources of capital. The fintech sector alone contributes approximately £6 billion to the UK economy annually, and since 2017, annual investment activity has doubled. 56% of incumbent financial institutions now have disruption at the heart of their strategy. Already, today's fintech landscape today is very different to that of 2019 or even earlier in this year, 2020, and there are immediate challenges to defend against the economic shock of COVID-19 to ensure the sector can play a part in the UK's economic recovery. This is why the UK government yesterday announced a Future Fund, a £1.25 billion package of funding to protect some of the UK's best and brightest venture-backed companies that are driving innovation through COVID-19 to ensure our long-term competitive advantage in innovative sectors such as fintech. Moving to the future, over the next decade, we may start to see the amplification of existing trends. For example, whilst London remains the incumbent centre of investment, receiving 88% of total investment, the distribution of the UK's academic and technology centres around the country are starting to result in more financial services businesses setting up or moving outside the capital, increasing further the number of stakeholders and, critically, the pool of talent and opportunities for businesses looking to enter the sector. So with this in mind, to kick us off, perhaps I'll start with you, Margaret. Given your broad perspective of the sector, can you give us a sense of how innovation and progress are changing the ways things are done in financial services and perhaps beyond?
Thanks, Antonia, and thank you to Innovate Finance for this invitation. I mean, I think it's fair to say that the impact of innovation has had a differential impact across the financial services landscape. So we think that, for example, in investment management, that we've had innovation that has improved the delivery of services, you know, to make, for example, to make it easier to track one's investments online, but has not necessarily disrupted the business model. In banking, which I think is going to be probably the focus of our discussion today, given the panelists, I think what we are seeing is disruption, and particularly in the payments space. And when we talk about disruption, it's a word that is often bandied about and is often seen as a synonym for innovation, but in fact it's something quite different. It's when you have got forces that actually change the way in which the industry operates and change things in such a way that it's rather difficult for incumbents to respond. And so in particular, those forces, I mean, we've seen the banking industry has been buffeted by several different forces over the past decade, but in particular, technology has had an impact in two distinct ways. Firstly, as we all know, technology is changing the customer experience across a range of different walks of life, be it hospitality, be it travel, be it retail. And so when people look at their banking services, they want the same sort of accessibility and ease and convenience as they see in those other industries. But also, and tellingly, it's reducing the barriers to entry. Not so long ago, if you wanted to be a bank and have access to cheap deposits, cheap funding, you needed to have a large physical branch network. And we've seen that that's no longer the case. And that's why we have seen the launch of several new banks, many of which do not have any branch network or indeed any physical manifestation at all. So that's one massive difference is that just the face and what we think of a bank, our mental image of a bank, which used to be this, august Victorian building has changed. So that's one thing. Also, there's been a rise in competition because of those forces. And one of the things is that, for example, phenomena like open banking, the big initiative by the UK government, that would just simply not have been possible. And so the whole range of services and the apps that we've seen off the back of it, that would not have been possible. And then finally, in terms of reducing the marginal operational costs in the way that, a lot of fintechs are doing, and that the banks are now adopting for new products, that means that we will be able to pursue goals of financial inclusion that were very difficult before.
Excellent. Thank you. Thanks, Margaret. So moving on to John, it'd be great to get your insights on the current liquidity landscape that businesses find themselves facing. And if, as some argue, fintech was born out of the financial crash of 2008, could the current crisis give rise to future opportunities or business models for the sector? And what do you think these might be?
Thanks, Antonia, and thanks for the opportunity to be on the panel. I'll come back to the first part of your question at the end, but first I'd just like to give a couple of reflections on the opportunities for business model disruption and indeed, I think, business partnership going forward. There's no question that technology is playing an increasingly dynamic role in the creation and expansion of the business ecosystem that Margaret referred to earlier, and that business ecosystem and how it interacts with consumers. In the last decade, the emergence of rapidly deployable, new and easily accessible technology has presented a very significant challenge to less nimbly architected incumbents in our industry, and it has also given disruptive, well-organized insurgents the opportunity to carve a sustainable, more permanent role in the ecosystem that is evolving. And much more so than the financial crisis of 2008, I think the ready access to mobile devices has driven a change in consumer behavior and has sent their expectations on service and product offering through the roof. This, I think, has powered a real opportunity and urgency for innovation across financial services. And today, customers demand highly customized and personalized journeys, delivering quickly against customer expectations and doing so at a very low marginal cost has been a real challenge for incumbents. And I think it has fundamentally framed a real opportunity for new entrants to create long-term, sticky customer relationships that are more positive than historic relationships. And it is actually in this paradigm shift that has, in fact, been at the heart of New Day's business model in recent years. And, I've been with New Day now 7 months, so I can't claim it was my architecting, it was the team before me. But providing a feature-rich, omni-channel experience across 18 different brands and managing more than 150 million separate logons annually across our 5 million customers has only been enabled by massive re-architecting of our own core capability. Our systems are now fully public cloud hosted. We have invested in robotics, as you'd expect, in artificial intelligence, in machine learning to drive a better customer experience, better understanding of data, better scale economics, and indeed, very importantly, better partnering arrangements with our brand partners. I think the current crisis has accelerated e-commerce by many years and will put huge pressure on incumbent, less advanced technology stacks across the industry. I believe that the current crisis will exacerbate the need for low-cost, highly scalable, highly intelligent capability. It will give and drive greater partnering across the ecosystem, as I think incumbent players will realize that leveraging best-in-class, scalable, tollable parts of the value chain is the only way to provide the service that customers are expecting and indeed can be delivered at a low level of cost economics. Now, if I turn briefly to the first part of the question, just before I hand back to you, we are a wholesale funded business and we rely on normal functioning markets to efficiently fund the credit that we pass through to our own customer base. During a disruption such as this, and that we are currently experiencing, this availability is indeed more limited, and investors quite reasonably have reduced their appetite and are standing more on the sidelines. I actually fully expect that markets will normalize once the fog clears economically, and that good and frequent issuers such as ourselves will be able to resume a more normal market access. With those remarks, I'll hand back to you, Antonia.
Great, thanks, John. So Andy, I'd like to bring you in, and I'm interested to hear how important the consumer or SME is in how you develop your products, and how you ensure that the innovations you're deploying will resonate with your consumers. And perhaps why are you building these in-house rather than partnering with fintechs or acquiring them?
Great, thanks, Antonia. A few questions in there to let me unpack them, but first of all, thanks for having me. And I just wanted to kind of put it on record to say well done to Charlotte and the team for helping lobby around the Future Fund, because it's fantastic work they've been doing, and it's really important we have a kind of a fintech startup ecosystem at the end of all this. So well done, Charlotte. I guess just before I jump into how we do it in NatWest Ventures, some of the points that Margaret and John make, I think I really agree with in terms of accelerating customer journey and digitization, UX. But I think there's a debate to be had whether there's a real disruption of business model itself. If anything, this crisis is kind of pointing towards the basics of how you survive in, how you make money, or how financial services operates in terms of NII and capital and all those things. And I think one of the great things that fintechs have done over the years is really raise the bar in terms of customer service and maybe accepting payments. I do wonder when we get out of this how much real business models will have changed, but maybe we'll get onto that later in the debate. But back to your point, how do we think about customers within NatWest Ventures? Of course, they're at the heart of it. We're the biggest lender to SMEs in the UK. I have a portfolio of ventures supporting SMEs, so I have no end of data that I should and need and do indeed use to create solutions. But I would say that it's a little bit more nuanced. I think often the debate in this area goes on to co-creation and sitting down with customers and coming up with ideas. And of course, you do need to do that. And I'll give you a good example. So Till, our kind of best-in-class merchant acquiring business that we launched, is going to have a loyalty feature within it. And if you don't sit down with customers, really understand their behaviors, customers and merchants, consumers and merchants, you will fail, like many other loyalty apps have failed. And the team are massively aware of that, and they're sitting down with customers and figuring out how to get this right, how to make it absolutely easy. But there are some things that you can easily miss. So the most prominent feature that customers love out of Till is the fact that we do next day settlement for merchants. The industry standard is 5 days. We didn't have to talk to many customers to figure out that we needed to do that, and customers have loved it. And they indeed did. And that is the most important feature that we have in Till. You can also get it wrong, right? So, I work with lots of engineers and designers, and they spend most of their time on Apple products. So when we launch, our digital platforms, they tend to be on iOS, and then typically the SMEs are on Android in the UK. 40 or 50% of the UK SMEs use Android. So if you're not careful and you get lost in all the co-creation, you can miss some of the big stuff. But to your question, I think it's massively important to have customers at the heart of it. If anything I've learned is make the product as easy and frictionless as possible, because if you don't, you will fail despite anything else that you do. On your question in terms of partnering, build by our partner, I've done all three successfully. I think it's Horses for Courses. Metal, our digital platform, we largely built ourselves, lots of coding within it. lots of our own infrastructure. Granted, we used about 60 SaaS products within there, which we needed to do. It's an expensive thing to do, but we thought it was right on that instance. We have partnered, so RapidCash, our invoice finance business, and Esme, our lending business, use Waddle and EasyBob as their kind of basic platforms underneath. That's been really successful. And then Till we built with Pollinate and got external investments in there, and we bought Free Agent. So I've done all three. If I had all things being equal, I'd rather partner, quite frankly, because you're getting a partner that knows what they're doing. They've often spent years and years figuring out a particular part of the industry, a particular part of the value chain, whether it's understanding invoices globally better than anyone else, and then you can white label it. It's cheap. But that's not often the case. So you can, I think you do all three, look at all three, but my instinct is definitely not to build in-house. That if I can avoid that, I almost certainly will. Back to you, Antonia.
All right, great. Thank you very much, Andy. And I mean, you mentioned new business models. And I think that's a very interesting question, which is, what do you think the new normal looks like for financial services? And we've seen in just the past few weeks, banks and other institutions adopting digitalization programs, which in previous lives would have taken years to implement. And where do we think this pace of change leaves incumbents? And likewise, given fintechs have yet to navigate an adverse credit cycle, where do we think this leaves their future prospects? So perhaps, John, I'll start with you on this.
Sure. I have the unlucky CV of having worked in a large bank, or a couple of large banks now, and now sort of in a sort of a fintech styled environment. So I'll give you my perspective on what I see. But look, I think both fintechs and bank incumbents will have their challenges out of this crisis. There's no question. I still think cumbersome legacy technology and cumbersome legacy processes and interfaces will continue to frustrate incumbents. And I think the culture that's embedded across many of those firms, just given their size and legacy, will not easily allow great innovation, despite the fact that this would be the intention of management to drive it through the organization. I think the crisis will and should drive a heightened focus on core capability, and I think this is an important point, and the need to build or acquire it. I think incumbents will accelerate investment, and I think they will seek scale advantage as we come out of this crisis, where it will be obvious who is strong and who is weak. And Margaret refers to low barriers to entry in her remarks, and I'd like to just touch on that. I think some of the business models that have been built over the last few years by some of the neobanks and indeed some of the new fintechs have highly unproven profitability models, and indeed the ambition to lay down losses to grow turnover and grow customer bases has worked for a few fintechs, but has not worked for the majority of them. And this is something I think we will see unveil itself in this accelerated sort of economic sort of separation of the strong and the weak. I think many fintechs with unproven through the cycle businesses will face different challenges to their business models. The acquisition of customers, with not focusing on the cash burn, will become a big focus for them and their investors. We'll see if they can sustain growth, whether they can sustain the cash burn, and whether their investors will indeed stay with them in this recessionary environment. And luckily, at New Day, the company that I'm currently working on, we had our genesis in what I would describe as Jurassic technology, where we had traditional credit card business with the reliance on heavy mainframe and heavy in-house technology. And what we've done over the last few years is invest very heavily and significant amounts of our own profits in re-architecting the core capability such that it is now infinitely scalable at relatively modest marginal cost. And I think that helps us become more than just a credit card provider, but also someone who can potentially externalize the core capability in a partnership model. So, look, I think there's going to be a different set of things emerging out of this for different players, and I think the landscape and the waters will separate quite quickly. Antonia, back to you.
Great. Well, thanks, John. And perhaps Margaret, is there anything you want to add to that?
Yes, I do. I mean, I think that clearly this has been a massive kind of jolt to all of us. And I do think that, in a way, one of the things that's been amazing has been, the extent to which, for example, a lot of financial services have just managed basically to spin on a dime and manage to keep on operating. Maybe it hasn't been smooth, but of course, they have also been subjected to kind of a huge increase in volume of inquiries. So they've sort of had a double whammy of, huge increase in operational demand at the same time that they've sort of had to go to remote working. So I do think that will lead to a questioning of whether, how much of that model can or should change, and people will look at the real estate and also their tech investment, because while it successfully happened in the sense that things didn't really fall over, I think there will be a question as to whether the current operation is ideal. And whether, ironically, there might be more investment needed in technology and indeed particularly to make sure that regulatory concerns are met. The other thing we need to remember, of course, is that, there will be a question still about accessibility in terms of physical location, branches, and access to cash. I mean, that was something we were all very focused on before we went into this. We've seen a decline in the use of cash, but I think that coming out of this, people might ask about whether we want to go as far and as fast as we have done. I mean, to John's point about cost and marginal cost, I mean, I think it's fair to say that, when we've looked at this, there's definitely been a difference across not just sectors within financial services, but also within particular subsectors like banking. And so, even when we first looked at this 5-6 years ago, we said that payments was vulnerable to disruption in a way that we felt that lending was not, or was much less so. And I think that John's right, is that business model of kind of, having continual losses to build revenue, it's a highly questionable model. It works in the good times, but these are not the good times. And so I think it's highly likely that we will see a shake-up, and we will see deals, not perhaps today or tomorrow, not while we're in the midst of the storm, but maybe, 4, 5, 6 months down the line. I think that we may see a lot of deal making and a lot of consolidation.
Great, thank you, Margaret. And I wonder, Andy, to move the question on slightly for you, I'm curious, given the speed in innovation at which you're being asked to digitise to keep up with current demand, for example, distribution of liquidity via C-bills, etc. How are you coping with that demand? And is that creating, shifts within the bank, either in the model, but also in the culture, and a realisation that greater automation is needed?
Yes, it is, in short. And I guess I should call out that it's my job as NatWest Ventures. I sit alongside the bank. I have my own tech stack that recognises a lot of what John said in terms of incumbent challenges we face. But picking up on Margaret's point, and I like a description, we can spin on a dime when required. And I'm very proud of the way that we've responded to not only C-bills, but to all the other government schemes that have been rolled out in the last couple of weeks. We've launched a product. We've stood C-bills up in absolutely no time. People working really hard to get that over the line. I think we've put $1 billion out there now already. It's the lion's share of the market. We've done 15,000 capital repayment holidays. We've done thousands and thousands of overdrafts. So we're working really hard on this stuff, and we show we can when we've got a single purpose. But recognizing, not all of this is digitally enabled. So I guess I think what you will see is there are some things that are structural trends that will kind of self-evident that they should continue. So, for example, our contact center is doubled in size from 200 to 400 dealing with loans, and it's gone from a kind of a large building in Birmingham to distributed in people's homes. That would never, ever have happened without this discontinuity. And I think that, we as employees and the bank as kind of people that pays for expensive real estate probably expect some of that to stick. All right, so we've now proven we can do it, but everybody wants it to happen. Previously, we had a stubborn residue of people not using digital, mobile app, etc. I think we've got a bunch of people over the line on that now, just because they have to, and we're helping them through it, and they're enjoying it, and the number of SMEs doing payments, digital payments, has more than doubled in the last couple of weeks. But I think what they are continuations of big super trends, I guess. You'll also see things that we weren't sure that would go down so well, right? So we've launched a vulnerable helpline for people that want to call up and talk to us, and that's going really well. And I expect us to keep that post-crisis. The bigger question then is how do you not rubber band back and go back to kind of slower times? And it's my job to keep us going on that. And I'm hopeful we will. And there's no doubt that automation. It confirms a need for it. We've since capital holidays 3 weeks ago, repayment holidays used to be manual. They're now we've now digitized them. So we're getting a lot of stuff done. But I do accept the challenge that doing the brand new, different, scalable stuff and taking advantage of the new opportunities, we need to continue to be on the front foot.
Okay, great. Thank you. So look, I'm shortly going to be handing over to some questions from listeners. So we've got quite a few come in, but do keep sending them in if you're listening. Perhaps final one from me. It's obviously undoubtedly been a challenging start to 2020, given recent data from CB Insights and suggestions that global fintech deals are down sharply year on year, and that total funding is down as well. So with this in mind, and with fintechs reducing their costs and extending their runways to get them through this difficult period, what can we collectively do to ensure that the UK fintech sector can bounce back and remain a global strength for the UK? And what role do you all believe that financial incumbents will play in shaping this new landscape? Should we anticipate a step change in the pace of innovation, for example? We've talked about some of this already, or at an institutional level. So perhaps, Margaret, can I start with you on this one?
Well, I suspect that it will accelerate the pace of both partnership and also deal making. I mean, as I said earlier, I don't think that deal making is maybe going to start today or tomorrow, but clearly the investor landscape has changed, investor appetite has changed. So I think the reality is just that we won't see so many fintechs saying, look, we're going to grow perhaps in a loss-making fashion, until we can IPO. I think that we are going to see a pragmatism come into those conversations. And so in terms of what incumbents can do, I think is just look to those fintechs for those partnerships and perhaps deals, and perhaps reopen conversations that may have fallen into abeyance in disagreements, perhaps over valuation in the past.
Great, thank you. Same question to Andy.
Yeah, I guess so the forward look always kind of makes me feel slightly uncomfortable in the middle of a crisis, and a crisis that's kind of humanitarian, and we've still got people dying in large numbers, and we've got SMEs and consumers who are really on the edge of kind of financial collapse. So the emphasis should, I think, be on all of us at the moment to support and do that. I do think, out of these crises, some innovation will come that is game changing, and I think it's a bit of a fool's errand, certainly at this point, to try and predict that. I was reading, if any of you read the Times, Matthew Paris did a fantastic article a couple of Saturdays ago about what it will look like afterwards, and it was a real antidote. And he said, the world will look pretty much the same, but we'll all be poorer. And he went on to kind of talk about, at this point, post 9/11, everyone's talking about the end of the skyscraper. So I do kind of worry about looking forward too much. I do think it sounds like we'll have less investment money coming into fintech. Certainly banks will have some tough times going ahead. I was reading a Morgan Stanley report a couple of weeks ago that had 5% coming off our core tier 1 ratio. So innovation will have to come with less money going at it, I think. Which means we'll have to get a bit more selective. I think any innovation that gets cost out will rise to the fore. I think stuff that doesn't have obvious value back to the consumer, they won't buy. It won't hang around very long. It won't get the kind of the road runway that it's had previously. And I think you look at lending businesses. I think once the dust settles, what will that look like? The alternative lending sector, I think it's going to be very, very interesting. But, I think we really do need a good ecosystem out there. I think there's going to be some interesting opportunities. Old folks are sitting on pensions that aren't the size they were a few weeks ago, nor are their houses. So there's going to be real opportunities in that market. Cash flow in terms of SMEs is going to be more important ever before. I really, really hope that the ESG and the climate agenda stays at the fore. And I think, certainly at NatWest, I was very proud that we took a kind of bold lead on that a month or two ago under the wrapper of our purpose. And I do think that some of the actions that we've taken under kind of Alison's leadership have been really positive in that regard. And I hope that the kind of the financial services community, and particularly the incumbent banks, use this time to reposition themselves as with real trust and affection of coming to kind of help the economy at this time and beyond. And I think that's the most important thing for me as I look forward.
Great, thanks, Andy. And same question to John, and then we're going to shift to questions from the audience.
Okay, I think a lot of what I might have said has been covered, so I'll just make a few points. Like I do think, of course, back to the point that Andy made about every business needing a North Star to guide it in terms of its purpose at a time when frankly, the reason that we've had accelerated economic disruption is actually one of a pandemic. So we all need to have that in mind, of course. But if I step sort of away from the fact that, we must be there to support our customers and we must be there to support society and play our part, I think when we come out of this, after a very long period of economic expansion and indeed the piling up of debt on the consumer balance sheets and indeed across the country's balance sheet and business balance sheets, we will naturally look to try and make ourselves more efficient. And I do think we will see a significant amount of deal doing, which I think will make the fintech sector stronger, and I think will make the incumbent banks more focused, all of which will give rise to a smaller number of better companies focusing on what their unique selling proposition is. And I think that's an exciting thing to be doing. I think we'll go back to a ruthless simplicity as to what our core purpose is, and we will go back to the fundamentals of whether things are valuable or not. You can only be infinitely valuable if you can infinitely dominate, and 99.9% of companies cannot do that and should not be valued on that basis. So I think we get back to a little bit like post the dot-com world, when we had the dot-com burst, when everyone realized they weren't investing in things that were ultimately going to be valuable because they couldn't ultimately stand on their own, and they were building businesses to be acquired rather than businesses that could survive. I think we will get through the fog and see all of that. And I think that's going to be a moment when we have some exciting deal doing. So I'm looking forward to it.
Great, thanks, John. And so there's a good question that's come in on the from the audience, which is related to, you mentioned core purpose. And the question is, Mark Andreessen of Andreessen Horowitz said yesterday that new companies should build something meaningful, even if it forces the incumbents into building things too. We've seen this in fintech already, but do the panel see incumbents building in a more meaningful way coming out of the COVID-19 crisis? So, Andy, can I put that one to you first?
Thanks, Antonia. Look, Mark Andreessen's much cleverer and insightful than I'll ever be. But I think his point, and I did read his letter, it almost read like a political call to arms that America is a kind of a big incumbent superpower and got a bit lazy, and it wasn't taking risks and it wasn't investing in kind of new stuff to do. So I kind of get the point, which is be bold, do new stuff, don't spend all your money wasting time into a slow decline. And I think that's my job in NatWest, right? So I'm lucky enough to be given a decent chunk of money to build new stuff and to kind of put it into our customers' hands. And throughout all of this, no one said to me, stop doing that, Andy, because we need to put more people in the contact center. It's going to keep doing it because this will be more important going forward. But yes, should economies not only, and I don't think it was a fintech point specifically, should the economy build more stuff and do different stuff? Absolutely. And I really think there'll be some vibrancy coming out of all this, which will become a building, not quite a kind of post-war building boom, but positive economic activity.
Great, thank you. And Margaret, what's your view on that?
Well, I think it's definitely the case that, what was Adair Turner's line coming out of the financial crisis about sort of, the social purposes of banking and Paul Volcker sort of saying that the only useful innovation was the cash machine. So I think it's always incumbent. I mean, financial services plays a core part. I mean, we are the sort of bloodstream at the heart of the economy, and it's incredibly important in everything that we do that we keep that in mind, not least because this has been a terrible shock, and sadly we are going to see real need in our economy going forward. There's a huge amount of financial vulnerability. It looks like unemployment is going to go up. So I think all the more important for us to remind ourselves of our responsibility as a sector. I mean, the other thing I think I would say is that yes, innovation is necessary, but I think that one of the things that we will have to bend our innovative minds to is that the goal of building resilience. I mean, I think that as a species, we've been hubristic in assuming that pandemics were a thing of the past. And I think we will need to build resilience at every level, at state level, at corporate level, and at the level of the household. Now, that's been really tough for the household because personal savings took a battering with the financial crisis, and then because the real income did not grow very fast, it was very difficult for many households to build up their buffers. And I think that as a financial services industries, that's what we should be turning our mind to, is how do we help the SMEs that Andy serves, the individual that John serves, and the government? How do we collectively work to build our resilience so that if, and God forbid, when this happens again, we will be better prepared to withstand it? Back to you, Antonia.
Great, thank you, Margaret. I mean, I might turn that slightly, in a way, into a question for John. So what can be done? I mean, first of all, do feel free to comment on the Andreessen Horowitz comment, but actually, what is it that can be done now and what needs to be done collectively in order to build in that sort of resilience? And what do you see as the risks in that space?
So I think weak businesses create non-resilient systems. So I think we have to carry on with the great experiment that has been accelerated during this disruptive time, which is digitization has certainly advanced, and I think e-commerce has advanced in periods of years during these last 2 months. That gives rise to a whole new ecosystem where, for example, where consumers meet SMEs is a great example. With the effective closure of the high street because of the circumstances we find ourselves in, we now see the point of sale where credit collides with the SME customer interface, where the decisioning about whether someone can buy something or requires or needs credit for something is all happening at a much more accelerated up the food chain space. I don't see that going back to where it was in terms of how customers behave historically 8 weeks ago. So I think we now have a fundamentally changed ecosystem that we will all need to invest in, simplify, and make resilient. The use of cash on cards, for example, has gone dramatically down in the last 6 weeks. The level of spend on cards has almost halved across the developed world in the course of the last 6 weeks. And we see people hoarding their resources because they are in fear of what might come next. And I think the financial system has to wade in behind that. We have to widen our appeal. We have to make sure that we provide credit into the corners of the economy that we haven't done so in the past. And we have to keep ruthlessly unbundling the services that we've naturally been able to bundle in a world where actually the customer is going to be able to, I think, access lots of pieces of what we used to do rather than having to buy it all from one of us. So I think, again, it's a sort of a long-winded answer to a complicated question, but the consumer is going to be in the driving seat on how we engage with them going forward, and that's exciting for all of us.
Great, thank you. So there's another question that's come up from the audience, which is COVID related and also really on the supply side, which I'll probably put to Margaret first. Do you expect to see an explosion of M&A activity within the market once the COVID-19 fog clears, or indeed during the COVID-19 fog, I expect? So Margaret.
So I do think that it's likely that we will see a degree of consolidation. I mean, I think that John is quite right to point out that many of these business models had at their heart a degree of loss-making that has been successful for certain huge online retailers that shall remain nameless, but it's not always a successful strategy, and certainly not if you're not funded. So there are a number of business models that were inherently vulnerable. I made a point earlier that a lot of businesses have just, are built with a low marginal cost. But actually, if you look at their complete, their total cost, their average cost, they can be very high, partly because of the investment that you need in terms of technology, and partly also because, of course, you need to scale, and acquiring customers is very expensive, particularly in banking. So for those reasons, I do think that there were business models that they were designed for a certain world, a world of growing economies and kind of cheap money and easy money. So that world has gone. I don't think that we're going to see an immediate, kind of a space of deal making, partly because we know that, all the incumbents are focused, laser-like. I mean, we heard Andy talking about exactly what he's been doing at NatWest in terms of building, doubling the size of call centers, ramping up to make sure that they were able to just, deliver just, £1 billion, under the CBIL scheme. So the banks, first of all, have had their own operational challenges to focus on. The other thing is that John talked about the fog. It's not quite the fog of war, it's the fog of the pandemic. The outlook is still very uncertain. So I don't see boards, and frankly, I don't see the regulators, more to the point, being particularly comfortable with spending on anything that isn't absolutely core, unless and until we have a degree of clarity. It might be the case that it isn't quote unquote over. I mean, it may well be we have to learn to live with this virus, but I don't see a space of deal making until the fog lifts a little and there's a degree of clarity on the way forward. Thanks, Antonia.
Great, thank you. And so, Andy, I wonder if I can bring you in on that one.
Yeah, I mean, I don't have a huge amount to add. I mean, I'm really pleased that John and Margaret have kind of expressed so clearly the kind of the resilience of business models and which will survive and which won't, because I think it's really important. And as the banker in the room, I didn't want to be kind of calling that out necessarily, but I do think the birds are coming home to roost on some of these models. In terms of M&A, I mean, I think it's really hard when businesses are holding back dividends to imagine too much M&A, even though there will be inevitably people looking for a deal. I guess if you include private equity, there's a ton of dry powder out there, so you might see some of that activity, but they'll be looking for their money's worth, I guess.
Great, thanks. I mean, John, I'm sure you've got lots to say on that one as well, but actually I want to move on slightly to get through some of these questions. In particular, it's quite an interesting question about financial exclusion, which is that fintech is sometimes accused of being the preserve of middle classes, and how can we engage people more with open finance and banking to address financial exclusion? So can I ask you, John, to pick that one up?
Yeah, for sure. And actually, that's a topic that's very close to the heart of the business I'm running today. So we're a near prime and prime partnership business. So we tend to be banking people who are either new to credit or recovering from credit events in parts of our business. And our North Star, our manifesto, is around helping people be better with credit. That is the core purpose of the company. Now, nearly 2 million people last year, we helped improve their credit scores out of our 5 million customer base. So it's a very, very important part of this mantra of being a business with a true, unique selling proposition and a purpose. Now, financial inclusion goes both ways. We can't just include people and then continue to have a cost of providing with them. But I do think we need to be reaching into more of the corners of society and ensuring that, for example, the deposit base of the country is being put to work in parts of the economy that the natural incumbents exclude. So, where you're gathering deposits as a bank, your job is to transform those deposits into the productive economy through lending them out, either for house purchase or business and wealth creation or whatever. And I think that the current way in which the UK banking system is set up doesn't get those deposits lent well into the corners of the economy that others have to lend into. Now, that's not a poor man's story for me, because we have a very sensibly organized business that funds itself in the wholesale markets and with bank financing. We don't use deposit funding, but we do tend to finance parts of the economy that are not naturally financed by the incumbent banks. So I think this will be something that the political agenda will return to once the fog clears.
Great, thank you. And I might ask Andy to comment on the same question.
Yeah, I mean, I think just reflecting on that, I've never thought of fintech as a middle class proposition. I I think of what they do, and we're doing lots of it too in terms of stuff around gambling and vulnerable customers. So I see us and the fintech community doing more in that regard. I mean, clearly, when you've got most of the country have got a smartphone and you've got digital propositions, you should be pulling on the financial inclusion element. And I also think that post this crisis, the neat segmentation that we currently have in our businesses as to kind of who's prime, who's subprime, who's mass affluent, that all might go away because lots of people are in for a shock. So I think finally financial inclusion agenda is probably on the up in financial services, not least because of the whole purpose ESG agenda, but also because of the moving segments that we're going to see post this crisis.
Great, thank you. So look, we're going to finish in 5 minutes. So what I'm going to do is wrap together two of the other audience questions that have come up, and then ask each of you to comment on that, and then we'll wrap up after that. So the first one is what do you see as being the strengths and weaknesses of and opportunities for and threats to fintech as a sector in the UK post-COVID-19? So we've touched on some of these things already, but perhaps if you can use these as your summing up remarks. But also in particular, there's a question about, given remote working is going to be a priority in the future, how that sort of both digital engagement for employees, but also digital services is going to be part of that, which links into another question about the pivot to new technologies. So perhaps I can thrust those three at all three of you in turn. And why don't we start with John, please?
Sure. So, look, I think the real challenges for fintech is, one, the word fintech doesn't really mean anything. It's just a whole load of new business models trying to disrupt an existing value chain. And I think the real challenge is unproven business models. Even the neobanks that have been built have tended to build their businesses on gathering deposits. They haven't then actually really lent them out or put the capital behind them to lend. So I think that across the payment spectrum, across the lending spectrum, across the banking and fintech sector, I think the question on proven business model is the big question that stands to fintechs. So that would be the first thing I'd say. On the sort of the working from home and digital disruption, I absolutely think that the great experiment that every business in the UK and across the world has just been through has fundamentally thrown up in the air any reluctance to create remote working or indeed flexible working for the employee base, which I think lends huge questions to why we're expanding our businesses in city centres and making people travel to work every day. And I think that becomes a fundamental business question and a great possibility to take cost out. So, look, I think that the pivot has already happened. I think the technology that's being introduced in the world, like blockchain and the sort of move to public cloud and the making sure that our people are capable of digitally connecting and doing their jobs on all of our systems from a remote place. I think that genie has left the bottle, and I think we should all look to the opportunities that it creates. But I do think it creates structurally a smaller workforce and structurally a more cost-effective business model, but there are ramifications at a macro level for that. Back to you.
Brilliant, thank you. Margaret, can you give some comments on that, please?
So I agree with much of what John said, so let me just pick up some other factors. So one thing that we haven't yet discussed, although it can be implicitly been in some of the remarks about funding costs, is that it looks like we're not going to just be in a low for long, but a low for very, very long environment. And a lot of these tech businesses, I mean, I think low for long is a pressure for banks, but it's particularly going to be, I think, a pressure for fintechs. So I think that is going to be an additional pressure for any kind of banking-related business. For those who like their history, they may have enjoyed a paper that came out from the Bank of England, sort of going back 800 years and saying we're on a structural kind of path where this is the new normal for a very long time. So that's a challenge. To John's point, I think he's probably right that it will be sort of a structurally smaller labour force, and that will raise a question around the degree to which banks, among other companies, around their supply chain. So banks are not the only organisations that have had offshore call centres, and like car companies that have had their own supply chains disrupted by closing of borders, etc. I think there will be a question mark about whether there will ought to be a reshoring in terms of resilience, and perhaps even that call centres might be replaced by more digital solutions. And then on the remote working question, I mean, I do think that this massive forced experiment has definitely shown that it can work. Whether people want it to work is another question. And I think that what we will end up with is somewhere in the middle. So it won't be the case that we say, well, everything has got to go back to being kind of in city centres. But I do think that, first of all, a lot of employees have not found this to be an entirely enjoyable experience. And also that it's not necessarily for every single function. It may be good for certain things like call centres. It may be less good for innovation or any of those things that rely on kind of the serendipitous interaction. Thanks, Antonia.
Great, thank you. And last word to Andy, please.
Yeah, so I really like John's characterization of ruthless simplicity and building a business to survive. I think focus will be on taking cost out. Specifically, I think if you're in a payments business and you're scalable and you found your niche, that the future could be good. If I was running a lending business that was kind of challenged on the funding side and the credit performance side, I'd be worried. And if I was a neobank that was relying on kind of deposit taking and building out a marketplace, I would equally be worried. But on the kind of working remotely point, I think the genie is definitely out of the bottle. And to build on Margaret's point of not everybody loves it, I often talk to lots of people, and there I remind myself there's lots of kind of 25-year-olds flat sharing in East London who are trying to log in that don't have spare rooms and a nice environment. And I think yes in the round, but not everyone's going to love it.
Great, thanks, Andy. So listen, we're going to wrap up. Thank you very much for a really good and insightful discussion. I think the overall picture is we don't know exactly what the new shape of either fintech banking or the finance sector is going to be, but clearly there's going to be significant evolution in business models and major digital disruption. And I'm very pleased to hear from all of you there's lots of opportunities as well as obviously quite a lot of risk. So very much endorse the idea of not wasting the crisis, and if insofar as this leads to more ruthless focus, but perhaps with meaning, that can only be a good thing, and in particular a good thing for consumers. So thank you to our panel, Margaret, John and Andy. Thank you to all of you who dialed in to listen, and stay safe.
Thanks, Antonia. Thanks, John and Andy.
Thanks all. Thanks, guys.